You know what? The uranium bears are right. It's all done. Let's just all sell out of all of our uranium stocks because obviously, right? Obviously, there's no supply deficit anymore. I mean, we no longer need that uranium power to power over 11% of the planet, or 20% if we zoom in on the US specifically. They're right. We have plenty of above ground supply, especially after the Sprott Physical Trust picked up over what 55.5 million pounds of uranium in just about 10 months, which is about a quarter of the world's demand for uranium. Just a little fact here, right? But they're right. Okay. The demand is totally not growing, like Japan restarting, France, the new 14 nuclear reactors that they announced. What do we have? The UK doing U-turns on uranium, announcing new reactors. Belgium, of all places, doing a U-turn, extending lifespans of the Great Duel and Thiehange. The US doing U-turns, expanding, and that's like, that's not happening. Okay, that's just uranium degenerate Twitter talk, uranium Twitter pumping, whatever they want to call it. Okay, that won't add any demand. The bears are right. They're right. The statement made by the World Nuclear Association on here that each gigawatt of electric energy of increased new capacity requires about 150 tons annually of additional mine production routinely, and about 3 to 4 50 tons of uranium for the first fuel load. That's all this is, that's just that the numbers don't matter. This doesn't matter anymore because every project right now at the pathetic $50 spot price of uranium, every project manager, every CEO, whatever, is ready to jump into production, and they'll make profits at $50 because, come on, they don't experience energy and food inflation, right? They just have to push a button and production will come online in like 6 hours, right? It's almost like magic. We don't have a structural and growing supply deficit either, while the price of uranium stays about 30% under the price at which CEOs have personally told me that they'll have to wait for the price before even considering pushing that restart button. Okay. But even the ones who have the ability to push that button, they tell me that it'll take them 6 months to a year if they work day and night and have all the luck and the regulatory approvals to get at least some extra uranium supply. Not a lot, not to meet the demand, but some. So yeah, sure, the bears are right. Okay, none of that matters, right? Come on now. How does anybody make sense of this, right? I don't know if I did an okay job bringing the point over, but I was kind of angry. It's kind of I was trying for sarcasm because those facts that I just went over, they don't just go away because of a liquidity rush is happening in the broad markets. Sure, if one's a better man than me, which is not hard, I'll give you that. But if somebody out there has the mental bandwidth and the iron balls to trade or do options or whatever superheroes do these days, then yes, there is a short-term bearish thesis for uranium that might have made sense, and selling at the top and buying at the bottom is the perfect strategy for all people who are able to tell the future. But I'm not. And I don't care one bit what happens during the short term if I don't have cash to be adding, because I sure ain't selling. Because again, I'm very sorry for using cliches here, and you can troll me all you want for it in the comments, but I learned under people like Rick Roll. Okay. And in the long term, this market will go higher. How do I know? Well, because Rick Roll tells me. Rick tells me, he's taught me that anything that has to go up and can go up will go up. And that's where we are at right now in uranium. Just like Justin June, by the way, said during one of his uranium market minutes, during which, by the way, I got a shout out. So I pretty much made it. But he was talking about how he stays calm during trying times. And he said that it's easy. And I couldn't agree more. It's easy to stay calm if there's two things. Because basically two things that I find are very important to do if you want to set yourself up to be able to be patient. But first of all, it starts with the research, okay? The goal of that research is to find out if the market that you're looking at has to go up and whether it can go up. So if you have green checks on both of those, then as Rick Roll assures me, the market will go up. When? That nobody knows, okay? Or well, nobody would be making videos in their parents' extra spare bedroom if they did. So it's safe to say that I have no clue when it's going to go up. And we might do another 50% down before it does, for all I know, right? But eventually it will, following that logic. I've done my research, built my own conviction. So that's my first big thing that helps me stay calm. It helps me stay patient. That's the first thing. Okay. So patience is the first big thing that you need to ensure if you want to live calmly through the volatility. That's the first P. Next, you would need to be the second P, prudent. I know I'm using words that are too fancy for my Eastern European mouth here, but hear me out. Okay. The two things are basically patience and prudence, as I said. If you're assured that you can be patient and you did this prudently, which to me, it means that you entered into this sector with money that, if lost, it wouldn't ruin your life. It's going to sting, but it's going to not ruin your life. So then why worry? This is about risk reward. Okay. Deciding what your position should be is about probabilistic risk reward. Big words again, I know. But if this sector doing a 10x changes your life permanently, that's your potential reward. But what good is that potential reward if on the downside, if the sector falls by 50%, then you get a margin call and you lose your house and your wife and your kids' college money? What good is that? It's like playing Russian roulette. Okay. The chances of getting the bullet are rather low, like 1 in 6 or 1 in 7 or whatever. But if you get the bullet, you die. Well, that's maybe a game that I'd play on a teddy bear on a watermelon or whatever. Though I respect watermelons a lot, but I wouldn't play it on my head, right? Stupid analogy, but what I'm trying to say here is that if a drawdown in uranium, like the one that's happening right now, wipes me out completely, then I wouldn't use my mortgage payment and my kids' college money on leverage, to add insult to injury, to trade some shit codes that don't produce anything and are looking at the highest inflation in the last 50 years or so. Okay. I'd go in, and I have, not on margin, sure, but not with money that I cannot afford to lose. Again, to bring up what Rick teaches me, if you go into a trade, he says, with money that, if lost, will change what you have for breakfast, you've probably done a bad deal already. So I guess if you don't like Rick Roll, by the way, fair enough. Nobody likes everybody, and nobody's liked by everybody, I guess. But maybe read Nassim Taleb and think about risk reward in combination with probability. Or better said, he speaks about expectation, which Nassim describes as probability times payoff, I think. This, by the way, also reminds me of Nassim's general trading strategy, in which he says that he likes losing 9 out of 10 times, but losing just a little bit, and then winning 1 out of 10 times, but winning that much, that big, that it doesn't matter for all the other times that he's lost. So I know I'm ranting. I'm about to cut it here, but I think that nothing has changed for the fundamentals of the uranium market. I think that's clear. I haven't seen 200 million pounds dropped out of the sky on a utilities parking lot. So my promise is in check here. And my prudence definitely is in check, because I live with my parents, and I can afford the high risk. So if I wake up tomorrow, I sleep literally over there, but if I wake up tomorrow and the entirety of the uranium sector has disappeared, I'd be pissed off. I wouldn't feel great, but I won't lose my house or my wife. So I can afford to be patient, and I'm trying to be prudent. If the current volatility has really stressed you out, that also might mean that you're overinvested or underhedged. Now, I'm about to shut it here because I also reached out to Gjermun, the Norwegian money manager, who invests friends and family's money, so other people's money. And I spoke to him a few months ago, if you remember, when he told me that he was 80% in uranium and also some gold and silver stocks, and then some base metal stocks, and I believe also some oil stocks and stuff like that. And when I saw people complaining on Twitter, I thought of him, because I didn't see him complaining, even though he's managing other people's money. He just got married and stuff like that. And I just wanted to see how he's coping with the volatility. So I guess here's that conversation already. So Gjermun, very important first question here. Did you watch The Northman?
No, I haven't seen it yet. It's I think it's the Swedish director, or at least actor. So we have a kind of a competition with the Swedes. So I haven't seen it yet. But,
okay, so you don't want him to make any money off you. Maybe you should go and find it on Pirate Bay or whatever.
Yeah. Yes.
I don't know, but I watched it during my 7-year anniversary with my wife. Like, I actually went to the movies. I don't do that ever. But for me, it didn't live up to its hype. It got a lot of hype, and a lot of people making sort of reviews on it. And I like, if I'm spending money on anything, I'm going to watch at least a few YouTube videos on how to do it, including stocks. Yeah. And so I watched a few YouTube videos on the movie, and sort of didn't live up to its hype. But that's also because, and it's also, this is maybe a bit thematic as well, going to the movies here is just pathetically expensive. I think we paid something like I want to say 36 euro for the tickets alone, and then another 20 something, like 22 or something for like water, so no carbonated drinks or anything, just some nachos, some M&Ms, and some like a liter of water or something was just like 22 bucks. So totally costed me like maybe 60 bucks or whatever to go to the movies. Um, and it was not a great experience. It's sort of that added to me being disappointed with the like just the whole experience wasn't great. But if you watch it, maybe don't get your hopes up and you're gonna have a better experience. That's what I have to say.
Yeah, I've only seen Midsummer by the same director, and it was very strange. And I think this is in the same alley as that movie. It's kind of artsy, and yeah,
Yeah.
and
No, it had it had a cool feeling and some cool effects, but yeah. Anyways, before we piss off some people here, let's talk about uranium. I promised people to bring them somebody on who's going through a paper law or a paper drawdown or something. And just for some background to maybe people who don't know you, we spoke a few months ago, and you told me that you were 80% in uranium and you're managing friends and family's money basically. So I wanted to start off by asking how you're doing.
uh, I'm doing well. Of course, this drawdown is hard for everyone, but uh, we this is a volatile sector, so you have to expect this. And uranium and most of the commodity sectors are not working in a vacuum, so they will be drawn down with the rest. So as long as you have some cash to deploy, you at least feel a bit aggressive and not that passive. So I had some cash to deploy this week, so at least the drawdown didn't. I got some okay deals at least. So.
Mm. Okay, but so you're not selling anything else to add to uranium? You're mostly adding from your cash position. Is that it?
Yes, I'm usually just adding. If I have to deploy, and no, if I have to reallocate, I try to do that when before I get on the roller coaster and everything moves a lot. So I did some reallocation a couple of weeks ago, but no reallocation now. Now it's just the new or adding to positions with the new cash. So.
Okay, so what does your portfolio look like right now? Because is it still 80% uranium and then 20% sort of gold, silver, base metals, and all the rest, or?
Yes, it is. So of course, it depends on the day now with how much uranium is down compared to the other stuff. But when I allocate new money, I allocate on that kind of basis too. So when I deployed now, I put probably 70 to 80% in uranium, a couple of percent oil and gas, a couple percent in tin, and a couple of percent in physical gold and silver. So
okay, interesting. It's interesting to talk about these things because you're doing this not only with your own money, and you're not selling at this point. I'm obviously not selling, and I've been adding as well from a cost perspective. I'm probably around 80% in uranium now as well. But most people that I follow on Twitter though aren't selling either. So what do you think is happening? Like, is this tourist who came in on expectations of like Justin Huhn said in the Uranium Market Minute on the people who came in on expectations of Russia sanctions and stuff like that, basically are those sort of disappointed that nothing happened? Is it algos? Is it margin calls? What do you think is happening?
I try not to speculate too much on it, but in general, I just see that it's a lot of leverage in the system. So when and if you are coming to, for example, as we call it, a tourist to uranium, you probably have some position in other risky sectors, for example, crypto, and they have had a horrible week. And if they have a risk-off situation as they have had, they probably have to sell some other positions. So it's just that everything is connected. So and uranium is not a safe harbor for this kind of moves down. So
Definitely not a safe harbor for pretty much anything. It's an interesting point that you make there, and I also wanted to ask you, but I sort of forgot, so I'm going to get back to it. You told me off mic that you're basically fully deployed right now. Like you don't have any cash, and the next time you're getting cash is just in a couple of weeks. So if you're fully deployed, do you think that there'll be better prices down the road to load up on uranium stocks, or don't you care about it? How do you approach it? How do you decide to go all in if you don't know if we're going to have better prices or not?
yeah, it's always what can I say? You always have to think if the fear of missing a move and being fully deployed, or being available for taking advantage of a further move down. So as far as I see it now, we have the price of the metal itself, uranium. I think we don't have that much downside from around $50 per pound we have now, because I think also the long-term contracts are around $52. I think they recorded in the end of April. So I think the metal itself, it's around the bottom, I think, but the equities, they can still you can still have the general market causing a margin call for people, and they just need to raise cash, and equities can still go down. But if we get a further move down, or we stabilize, or we get a V-shaped recovery, that's very hard to know now. So that's just why you have to decide if you think if the move is over, or you think a year or from now we will be lower or higher, I think. And I think we will be higher.
Good point. What I personally use for myself, and I don't think this should matter to anybody, but what I do is that I would ask myself, what would make me feel worse? Because I'm first of all, let me preface that by saying that I'm of the belief that we invest and speculate to sort of try and improve our lives. So if something's making me feel bad during investment, like doing options or leveraging my positions, that would make me feel bad, that would stress me out, I'm not going to do it. So because I'm doing this to try and improve my life, not make it worse and make some worthless paper, basically. I'm trying to improve my life. And so I would ask myself, which one of the two is worse? Is it FOMO or is it ROMO? Like which one of those, FOMO be the fear of missing out and ROMO be the regret of missing out? Which one would make me feel worse? And if I say like, okay, I cannot live with FOMO. I feel like, I'm going to miss out on that V-shaped recovery that people on Twitter are talking about, or somebody's hyping it up and I don't want to miss out. If that's really making me feel bad, I would probably deploy the money. And at the same time, if I'm like, okay, I'm not feeling any FOMO, but I might get ROMO, then I might approach this differently. There's also always the option of scaling in, because I had some cash this week and I didn't deploy all of it, but I deployed about 80% of the cash that I had. And yeah, that's sort of how I've been approaching it. What do you think?
Yeah, that's the thing every investor should have thought about in advance, I think. And I have done the same. And I would rather kick myself if I missed the move, because I still get a steady cash flow every month, and I can just redeploy it if we go further down, and I will just cost average in, at least until we get to the marginal cost of the producers. And that's at least what my strategy is for now. And that's also how I'm able to live with these drawdowns. It's just cost averaging in and getting a better average price.
So just a set strategy, you know what you're signing up for and you know what you're going to be doing. So there's no reason to worry, right? You've done your research. You've sort of built your own conviction, so you can afford to be patient. And as Rick Rule says, there's two things that you need so that you can live through like a 90% drawdown, and that's patience and prudence. You can afford to be patient because you've done your research. You know that the only thing that separates us from 75 at least per pound uranium is time. That's the only thing separating us. There's no way around it. And prudence, you're doing this prudently in terms of you're not going all in on like 10x margin with your wedding money. Well, you just got married, but with your kids' college money or whatever, and with your rent, you're not doing any of that. So you can afford to be patient and prudent. And that's sort of what helps you throughout this down run. That's sort of how I understand. Is that right?
Yeah, I'm not touching any of those money. They're safely in the bank account.
That's good. What do you think? What do you think the biggest recoveries will be coming from? Like, did you expect people to start beating up the speculation plays once we get signal for going back up, or like should we look at like the decent companies like producers and like near term producers, or what do you think?
I've given it some thought, and I think that it depends on what kind of recovery we get. If it's the V shape, it's different from if we just go down, stay down for a long time, and then we slowly build up. And because if we just get into a recession, I would rather have, I think at least investors would like to see cash flowing producers like Cameco and Kazatomprom. So I think they will do better if we get what we call the worst case scenario where, and for example, the explorers or the high capex developers will struggle a lot with just raising capital to build a mine or explore more. So I think they will struggle a lot more during a recessionary environment. But if we're just, this is a V-shaped recovery, yeah, then it's the high cost producers, high cost developers, and explorers just just have the moose pasture in Saskatchewan. So
it also depends on the company. Exactly, you make a good point there, that it depends on the explorer as well. Because if you have a cashed up explorer that knows how to bootstrap, they know what they're going to be doing throughout like the next 12 months. They have their G&A, they have their drilling expenses, and they can not only sit this through, but they can without raising any money, without tapping the market for cash, they can work through this, doing some work, paying their G&A and paying their drill holes without tapping the market for cash. That could be a high quality play too, in my opinion.
Yeah, exactly. And I think if you have an explorer now that is drilling and not getting any results, and if we get in a recessionary environment, they will have a lot of trouble raising cash to just keeping the boat floating. So, and investors, they can smell if the cash is starting to run out. So then you will see a move down in the stock of the company too. So.
Exactly. This is where opportunities come, but this is also where the market comes to take away your money if you don't do enough research. Because sometimes you would see some of these, specifically in gold and silver right now, you would see some of these companies trading at like $1 million in enterprise value, meaning, their market cap, oftentimes they don't have debt, but their market cap minus cash equals 1 million. But the market cap is like, 60 million or something, and they just have like 59 million in the bank. That's a cashed up junior that the risk is very low for that enterprise value. But then at the same time, you could see a junior that's down from 100 million to 10 million, and then you could just be greedy and go and pick it up without looking into it. But then it turns out they don't have any cash, and now they got to tap the market at a $10 million market cap. First of all, they might have financing risks. They might not even find the money, and if they find the money, it's oftentimes going to be like loan sharks, and they're going to give them a horrible price with like horrible warrants and horrible options, and that could kill off a company and then draw your money into the ground. So that's you make a good point there.
Yeah, and it doesn't just have to be the mining sector. If you can have I just remember, I'm from Norway, so we had, for example, during the downturn in the oil price in 2014, you had Seadrill, one of the biggest rig companies in the world. It went practically to zero because they were cash flowing a year before and had high dividends. Everything looked great, and they just followed the market down to zero and had to restructure a couple of times, I think. So every investor there that went with them lost all of their money. So.
Okay, yeah, that's a bad story. So I know that you're paying attention to cash and when the companies in terms of raising. Do you also pay attention to the chart of the specific stock or the chart of something like the Uranium or the Sprott Physical Trust Fund?
Yes, I also pay a bit of attention to the charts because they are usually telling you something in advance. For example, if some positive news are on the horizon, the chart will probably usually always tell in some kind of way. So I try to look at the charts, but I also just outsource it a bit with at least following Uranium Insider and his daily podcast and finding value with Andy and just looking what they do because they have done it a lot longer than me. And I can just piggyback on them. And I don't agree 100% with them, but at least I'm in the right vicinity when I follow them.
So what else? What else when it comes down? So we got the charts, we got some of the fundamentals and financials that you pay attention to. I'm just trying to figure out what your sort of list of things to check is in terms of, is it macro fundamentals? Is it micro fundamentals on the sector alone? Company valuations, macro charts? We talked about that. Sentiment, is that something that you look at? Like, what is your sort of checklist of things?
Yeah, it depends a bit because first of all, you need to have a good market for at least expecting it to go up. So that way, I still look at the supply demand picture and how many life extensions do you have? How many new reactors are France and England planning to make and everything like that? And also more short-term triggers like Russian sanctions. We also have the long-term contracting coming up, Japanese restart, of course, mentioned a lot. And I thought about it a bit the last couple of weeks with just getting the rejection from the New York Stock Exchange. It's still possible to raise a lot of cash there. So you could have 3 big entities coming in there and just moving it up into a premium to NAV and just raising cash and buying up everything in the short run. So I've heard Rick Rule say that don't mistake brains for a bull market, but it really helps to have a bull market in the first way. So
I know what you're saying. Yeah, I think that about sums up what I wanted to talk about. Is there something that you wanted to add?
No, just that you need to diversify, not just in the uranium sector. You also should diversify some of your cash to other sectors and other assets. And most importantly of all, you should also diversify your attention. You should not follow the market every day. You still have a life outside this. So you should focus on what's important in your own life with work, family, and friends and everything like that. Not just refreshing the Twitter feed.
That's very well said. And I think you got that covered if you're exercising the patience prudence rule, because that means that the size of your portfolio relative to the size of your life with like your friends and your family and your job or your hobbies or whatever, the size of your portfolio should be relatively small to all the rest in terms of how much does it matter in your life. I think that comes into just some of the thoughts that I've been having.